think it was December 2022, we were at about 6.9% core inflation rate, and it's been dropping every single month since then. We're down to about 5.2%. So inflation's on the right trend as well. And so we're sort of, given the fact that interest rates are only elevated to control inflation, I think that the significant probability is that interest rates will start to come down, which will increase access to credit, which also will increase consumer confidence because people feel more like that they've got their standard of living under control. Hello and welcome. You're listening to Dashed Insider, the auditory epicenter for property investors seeking a life of freedom, choice, and abundance. Joining me on today's episode is Sean Simpson, repeat guest, repeat pest. Welcome back.
That's an excellent repeat pest to start off. That's very good.
So
keen to be here.
Quick little heckle on the way in.
Yeah.
Sean, the people want to know. People want to know what is going to happen in property investing in 2024, and that's what I wanted to talk to you about. You are, in our business, one of the few people that's really at the helm of looking at where is the market going. We often say, and we've said it plenty of times before on this podcast, if you want to make loads of money, work at where demand is going, stand in front of it and open your wallet. So part of that is to actually work out where it's going. And so I want to talk in this episode around where is the property market going in 2024. Some predictions, if you may. But before we do that, let's talk about 2023. Like, what's your kind of synopsis? So 2023 has been a really interesting year. We saw interest rates rising. I can't even remember how many interest rate rises we've had now, 12 or 13 of them. Yeah, I mean, it's obviously started in 2022, but nonetheless, we've had a loads of interest rate rises this year. We've seen changing dynamics in capital city markets, in regional markets. We've seen some buyers active, some buyers inactive. What's your take on a bit of a recap on the 2023 market?
Yeah, it was a very, very interesting year. I think it's a really good time to sort of reflect because a lot of the media coming into 2023 was, we're going to see corrections and lots of the media that a lot of people absorb is often very, very macro, and macro in Australia quite often just means Sydney or Melbourne or what's happening there. So it's pretty interesting to look back that, start or end of 2022, a lot of economists, a lot of big banks were talking about corrections, and we've actually seen, obviously, during COVID, it was this huge, macro unification of a lot of the markets in Australia all started doing the same thing, which was going up, which is actually the exception, not the norm. So as we came into 2023, we started to see all these different markets start to perform differently again and split off, which I think was one of the most interesting things, because the dramatic effect of how much they split off was huge. You started to have markets going backwards, some capital cities having corrections while the media's pumping out those headlines about those corrections. And in some of these areas that we're in, there is from strength to strength, it's significantly harder to purchase in them even compared to peak COVID times. So we even run a bit of a study not too long ago as well, just looking at gross listings, because a lot of people thought about, interest rates going up. There's all these fire sales, distress sales, and a lot of the places we're actually buying are currently the lowest volume of stock coming on the market in 17 years. And that's not even accounting for the increase in dwellings at that time. That's just gross number of listings, not a percentage. So
that's really interesting. What is your take on that? I mean, I kind of know why, but for the benefit of, what's your take on that? Why do you think that is? Because you're right, it's so interesting, the way the media treats the property market. This whole idea, and it was quite funny with the whole mortgage cliff thing, because this is part of the thesis. This is part of the thesis, which, anyone can go back on this. One of the things I love about this podcast is that it timestamps all the things that I've said. So, for good, bad, or indifferent, it's okay, sometimes I'm wrong. I'm not trying to profess that I'm always correct. But one of the things we were saying is is that the mortgage cliff is a non-event. But it was so interesting. I think it was originally it was going to be in February or something, and everyone's like, "Oh, it's all going to happen." Nothing changed, and then it was like, "No, it's coming up." And it just kept this thing that was going to keep coming up. And all of a sudden, everyone was going to be able to not afford their mortgages anymore. And everyone was going to have to fire sale their properties, and the whole property market was going to collapse, which is farcical. But
because they grabbed these ideas, these singular ideas, and they just painted on the whole property market. This is the mortgage cliff and this is what happens. And it's funny, I can even sort of start to run through some examples here and some data, which I'd love to show you guys. But in some places where affordability is something that I'm sure we'll get into in this episode, in some places mortgage cliffs did exist, and you saw an increase in supply. People couldn't afford their mortgages. In other places, the polar opposite.
Where's an example?
So
there's an inverse. Yeah, you said they're a polar opposite, and this is the inverse effect that I think is going to be useful. So, what's an example of a place where the mortgage cliff did
So I'm going to pull a few examples out.
Anyone who's watching this on YouTube, you're getting some inside. This is what we call the suburb selection dashboard, which most people don't get to see. And this is actually this is a tool that we developed internally to help us identify the right locations at the right time. So pretty top secret.
A crystal ball. So I just want to show you really quickly something on relative affordability and how interest rates can affect different places. So we're over in WA very, very quickly. I just wanted to show you this suburb here. You can see the median weekly household income of $1,557. And I'm sure if I pulled any of these little places, like let's just go over here, it's going to be significant. So $2,100 in this suburb. Mm-hmm. When you come over to the supply and demand indicators, this little orange line that we have down here is the supply of new listings to the market. So that's any listings that have been launched on the market. As you can see, there is just a steady trend downwards for a substantial amount of time. And in this suburb, just another thing to really, really quickly note, you've got the median weekly household income of $2,100 and a median sales price of, say, $500,000 if you're taking the average. Once you jump over to a capital, like let's just grab something expensive in Brisbane. If we jump up into central Brisbane, I can fairly well bet, let's have a look. So you've actually got a slightly lower median weekly household income.
That's
compared to
interesting. So that was like 2,100 down to whatever that is, 2,000-ish, yeah.
Compared to 2.6 million to buy a house. So as you can see, the delta there in terms of affordability is wild. Like the people earning the incomes in a lot of these, regional capitals or whatever. Hey,
Sean, we broke up there. I'm just going to cut you off because we broke up there. I didn't think we could record it. Let's not ruin the flow, but we just we dropped off just as you were introducing the price there. So what's super interesting about this is that the first place we were looking at there had a median household income of $2,100. This suburb, New Farm, median household income of $2,000, is slightly less than that, $2,069. But the price difference is phenomenal.
It's crazy, yeah. So that's the funny thing where people can paint these ideas where, hey, this mortgage cliff's coming. It's like the mortgage cliff in New Farm, I bet, is very, very real because people on the same income are paying however much that is.
Let's look at it. Show us let's have a look at the supply line.
Yeah, so if you have a look at the supply here,
isn't it?
You've had a dip where, interestingly enough, when did interest rates started in May, didn't they?
Yeah.
So here's May. So there's the start of the interest rate rises. You can see there is a little drop up. There's actually an interesting little
increase in listings. Right?
Yeah, increase in listings. So you can see two very, very different suburbs where interest rates have two very, very different effects.
Yeah, that's super interesting. And this is one of the things that I think a lot of people don't understand. And you're right when you said earlier about the the way the media treats the property market as this. They say the Australian property market, and it gets unfairly weighted by the market capitalisation size of Sydney, Melbourne, and also Brisbane to a lesser degree as well, because of the overall value of all of the properties in those markets. What happens in those locations tends to affect the on aggregate average across the country. And so the example that I always use for this is BHP is the largest single. It's number one on the ASX 200 is the largest size business in Australia. If the BHP share price drops by 10%, what is going to happen to the ASX 200 index? The ASX 200 index will probably drop by 2-3% or something like that. It won't drop by 10, it'll drop by a few percent because it'll be dragged down purely by the size of the biggest whale in the market coming down. And so interest rates, we did a study on interest rates and found that there was very little correlation at all with property prices. But that also doesn't account for the fact that in locations where you've got an extremely disparate, an extreme difference between the relative affordability, so the income versus the prices, necessarily that is going to have a larger impact. And that's typically in those markets where you've got property prices that are over $1.5 million as a kind of a general kind of mental model. The inverse is true though. Why is it that where there's higher relative affordability, why is it that there's less properties on the market?
Yeah, so this is an interesting one, again, where people think interest rates up, more stock comes on the market, people want to sell. It's actually the opposite effect in places that sit below certain ratios of relative affordability. And the reason that could be dialed into a huge number of things, and another interesting thing to note as well, there's been proven studies that, especially over the last little while, it not only has restricted overall stock, but the percentage of stock that's being sold by investors rather than owner-occupiers increases dramatically. So you can put that down to a huge number of things, but back to the first point, what we can get into is what I like to call sort of like a stock spiral, which is where owner-occupiers in a certain suburb, when there's virtually no listings to buy and their access to credit has been restricted by interest rates, the traditional move of upgrading the house or moving to a nicer suburb or anything like that, there's physically nothing for them to buy. So what that then does is that prevents them from listing their property for sale back in the original suburb, which then prevents somebody in the suburb further down looking to go to the second home, listing their home to potentially buy that one. And you end up in this little spiral where owner-occupiers just physically have nowhere to go. And it also causes some really interesting things with prices, because when owner-occupiers are in a market where there's huge investment demand, there's not a lot to buy, they're a lot less attached to what they pay for a home. And when they get into these chaotic situations where there's just physically nothing to buy, they might have sold and they have to buy something else, they start setting new precedents in market value, because a lot of the investors in the area, they'll tap out once it goes above what a CMA or a rear-facing valuation might say. These owner-occupiers might have a week until settlement on their place they've just sold and they need something. So they'll go and pay 50, 60 over listing price in some of these areas, and it continually sets this precedent, which I think can sort of drive quite a bit of growth.
Yeah, it's super interesting, right? Because what we're pointing to there is a two-sided marketplace effect. And so like the biggest issue with any marketplace model is that in the first instance, you have the cold start problem. Like you have to have some supply to meet the demand, and if there's not enough demand, then the supply won't be there, and vice versa. If there's not enough supply, there won't be enough demand. And so you have this, and so then that is why, if you can get it right, you can get a lot of growth in two-sided marketplace models. But also, you can get into a downward spiral if one of those sides of the ledger gets. So Uber is a great example of that, right? So there could be tons of demand, but if all of a sudden there's less drivers, there's going to be less ability for people to get cars when there's less demand. So then people will go, well, fuck this, it's not that reliable, I'm going to stop using Uber, and it starts to go backwards. Now, the other interesting thing that you pointed to there, that was really interesting, is that the property market in Australia actually operates on a matching market model. Now, which is really interesting. And so the difference between a commodity market, which is like pure supply and demand. Now, supply and demand does have an effect on the real estate market, but it's actually not the primary market model that affects the real estate market. The primary market model is a matching market model, because in roughly, on aggregate across all markets in Australia, roughly 70% of owners are owner-occupiers, roughly 30% are investors, which necessarily means there's more people that are buying emotionally. And because there are more people buying emotionally rather than just based on the numbers, they're prepared to pay a price based on how they feel rather than what is the kind of intrinsic underlying value of an asset, which is effectively the same as a dating model. Like if you think about like the dating market, like Tinder, right? So it's not about like male, female, match. Okay, man wants woman, woman wants man, match. It's like, okay, do I like the look of that one? What do I think about their personality? You know, and these are the things that define whether or not that there's a valuable match in that market. And the same thing goes in real estate. There's all these emotional characteristics. So a matching market exists when the pricing decision or the transaction decision is based on subjectivity and emotion, which is exactly what happens in the real estate market. Because like, do I like the look of it? You know, can I see myself in the kitchen? And so homeowners drive property prices far more than investors. And you're talking about people paying overs and all of that kind of stuff. And investors also then if they start to get to a stage where there's not a lot of stock on market, they start to get FOMO, they start to get emotional, they then start to go, oh, no, I want to participate. And so then they start acting in a way that's asymmetrical to the actual intrinsic underlying value. So it creates these really super fascinating market dynamics in the whole sector, which personally I find really, really interesting. Do you kind of, does that resonate with you as well?
Yeah. I don't have any graphs or data on property Tinder, but I do definitely agree. And it's actually critical. It's actually critical to think about, because knowing, especially when you're doing asset selection, having the end in mind when you're purchasing it and understanding where the demand is going to be for in that asset, if there is an exit plan or how you're looking at it, is critical. And to see the movement of that demand around Australia is also really, really interesting, because investment demand can shift at different rates to owner-occupier demand in different places. And it's very, very not just interesting, but critical to sort of understand how those can affect property prices.
Let's talk about that, and let's start sort of throwing our eyes into the future. Let's start also looking at about 2024. So the way it seems to be that the way people have been thinking about, and we've seen this massively in 2023, the way that people have been thinking about buying, particularly investors, but also owner-occupiers, because as I mentioned, owner-occupiers drive markets more than real estate investors, and you've still got that. You still apply the three, because of that, actually, you apply the three core fundamentals of location selection, which is jobs, lifestyle, and affordability, right? So because people want to be able to live somewhere where they've got economic opportunity, where they're going to enjoy living, and the affordability is relative to their income, right? And so if you've got those three things that are working well together, you have a stable market, which is good, a stable, growing, in high demand market.
I've actually got something super interesting, which I think I haven't showed you before, but I've been diving into some, we might get into this a little bit more with migration, but I've actually dived into a few little bit older studies, but studies that people have done as to why people will migrate intrastate, interstate, or from overseas. And
yeah, well, let's dig into it, because what I wanted to talk about was like how have these movement patterns played out, but then also where is it going? So let's dive into it.
Yeah, so I'll just jump over. So as you can see here, this study was done, I think 2019, but it was quite a substantial study as to why people might move around the state. And it's funny, when you start to look at the breakdown of reasons, when we talk about jobs, lifestyle, and affordability, you can see here, family reasons is a large percentage, which we probably can't hold on to, but you've got employment here, which is jobs, purchase-owned dwelling, probably affordability, wanted a smaller home or to downsize, probably affordability, accessibility, you can probably say affordability, lease terminated or not renewed by landlord is again affordability, bigger or better home, affordability, or lifestyle. So essentially all of the reasons other than family in this study that were seen as reasons why people would move are boiled down to those three things. And you can see it actually varies dramatically over the different age groups as well. And then another interesting, this is just the second part of that study, people were surveyed as to reasons that would increase their desire to move. And this one, funnily enough, doesn't have lifestyle on there, but a lot of people, there's some wild left-wing things in here.
But some of these things like, increase in cost of living, right? That's also going to have
a huge amount of affordability. Yeah.
But it's also going to impact lifestyle, right? So your ability to live the life you want, right? So these are directly financially related, like a 2% rise or more rise in interest. It's interesting that that the rise in interest rate, 2% or more interest rate rise was like the second lowest, right?
Now, this is freestyle. They surveyed a huge amount of people that had moved and just asked, why did you want to move? But you can see here, all bar, look, electricity prices are probably going to be similar everywhere, and COVID-19 was a separate discussion. But you can see here, loss of income, 2% or more interest rate rises, cheaper house prices, rents going up, or increased cost in living can all boil back down to jobs, lifestyle, affordability. So it's very, very interesting to see that not only have we just talked about this for quite a while about reasons why property prices would be driven by these things, but it's actually been proven that this is the main reasons why people would choose to move either around their state or interstate as well.
Yeah, it's super interesting. So given that, how do you see that playing out in 2024? What do you see? What's your kind of thesis on that?
Yeah, so we'll probably start top line with immigration and migration, because it's been a huge thing that a lot of people have spoken about recently. So I'll just give some context for everyone, because I know everyone's saying, immigration is going through the roof, but it's very, very important to understand the context that the current data that we have is from March this year. So it is a little bit dated, but it's March traveling backwards a year. We had an increase of 454,000 people into Australia over that time period. And that's over double what we were pre-COVID. So you're talking not just a slight increase in people coming into the country, a phenomenal increase in people. So you can see the population grew by over 500,000 people from the year to March 2023. So a massive, massive increase. So we will get into it as we go along, but you combine this with the existing housing crisis, lack of building approvals, not enough homes being built, you do really have a perfect storm to create a very, very substantial push in property prices in some places next year. So I think it's very critical that the crystal ball, we don't just say, look, Australia's in for a huge boom next year, because I feel like it will be a boom, but it will be in certain locations where you can move in front of demand like this. Not all locations will benefit from this sort of stuff.
Yeah, so I think it's a really interesting point. I'm just actually trying to look up some current migration stats as well, because I think that's really, really interesting. Because
there's a new
everyone thinks about it.
15th. So
got it. Yeah, okay, we're close. I was like, where's the new data? It's really interesting that you talk about that, because a lot of people, we've sort of talked about it on this show as well. The idea, well, there's increasing immigration, so there's more people, and there's less building approvals. Okay, so necessarily on a macro level, supply, demand, those two things don't meet. There's so many layers.
deeper than that you need to think about.
Well, totally, right? Because that discussion of like, we've had 450,000.
Yep.
Yeah, 450,000 people coming into the country. We haven't had that many new properties built, I don't think, over that period of time.
About 200,000 new dwellings, something like that.
200,000, right?
But that's not including normal population increase as well. So
a lot
of
totally. That's just immigration. That's not even organic and all of the other kind of stuff, right? And so, but that points to like a macro. That addresses the macro that says in Australia, the number of people has gone up by this much, and in Australia, the number of houses has only gone up by this much, and there's a deficit. What it doesn't point to is that some locations are going to asymmetrically be impacted by that positively and asymmetrically impacted by that negatively, right? And this is where it gets really interesting because, to your point, when during sort of 2021, more specifically 2020 broadly, we saw most markets in Australia move in a similar direction, which is super unusual. That's crazy. I didn't like it. I was like, this is not good. This is not good. Because we knew that some of those locations were going to go down again because they didn't have the underlying drivers, and they did. And so what we see now is a return to normalization where some markets will move and up, and some markets will move down, and it's going to become more variable. And because of the increased mobility that people have to be able to work from all over the place, the amount of people I've spoken to recently that are working from places they previously wouldn't have been able to work from because they've got Starlink, it's insane. Had a meeting this week with someone. They're like, "Oh, well, I'm visiting my parents in Tamworth, and for the first time, I can work from here because we've got Starlink." It's like,
I don't know about Tamworth, but
well, that's where they were. They said it was good, So, but I don't know. There's no prediction on Tamworth. But it's interesting because when you apply the lens of the sort of immigration context with the housing context, then with the lifestyle jobs and affordability context, you then start to realize that there are going to be some specific markets which will outperform based on those dynamics, because it doesn't matter where you're coming from. You still want the same things. You still want to be able to live a good life in a good place with good economic opportunities. You want to be able to have some money left over at the end of the day. And if you're in New Farm and the average income is $2,000 and the median property price is $2.5 million, $2.5 million, like, no wonder people are sitting there crying out and going, I'm never going to be able to afford a house. Yeah, no shit. Like, that's not good. That's not good. You can't buy a property there. That's crazy. But that's not all of Australia, right? And so there's plenty of places in Australia where the local relative affordability, because this is what people are going to get their head around. It's local relative affordability. Just because you're living in Sydney and earning $300,000 a year, your affordability based on you doesn't matter. What matters is local relative affordability. So what's the average income in the area? So it points to this kind of difference in the market. What else you got to? Any other kind of thoughts on that?
No, just another one that I'd like to throw in that I haven't actually heard anyone speak about, but it's actually the mobility of Australia's investment demand as well. We've been sort of seeing a trend that I've given the buzzword of the liquefaction of Australia's investment demand over the last couple of years, which is where we've seen a massive increase in the buyers advocacy space and geographically remote investment, which has actually caused some really sort of whack things in patterns everywhere. Like, for a good example, I've called it the Townsville effect, but up in Townsville about, say, May last year, all of a sudden interest rates went up by one or two. People freaked out and they're like, we need yields. We need cash flow. Yields is the problem. Townsville has exceptionally high yields. So all of a sudden we saw this just like flood of people chasing yields in Townsville. And then we saw growth in investor-based assets outrunning owner-occupier-based assets. So what I'm talking about there is like unit blocks, high-yielding things. Like, for example, speaking of an example of like getting in the way of demand and opening your wallet, like right when that first or second interest rate went up, I bought a block of units in Townsville because you could see straight away, all of a sudden people were like, we need yields, we need to come in here and start pillaging this sort of thing. So it's actually causing the movement of the investment-based demand across Australia to be a lot more mobile.
Hang on a second. What happened to your unit block? Was it good?
Yeah, I can go to the numbers if you want. Like
let's go to the numbers. I mean, use it as a real example. So you saw, this is a great example. You saw that investment demand was changing because the psychodynamic was that people were like, we need to chase yields. You identified that trend. You said, I'm going to stand in front of it and I'm going to go buy a unit block in this place so that I can see the demand is going. What happened? So tell us.
Yeah,
give us
because I could quite clearly see a huge amount of buyers advocacies were all of a sudden like clients need cash flow. We're running out of yield. Things are going negative when we've always said cash flow positive. So they just piled in. So we bought that unit block for $550 in June of that year. And I think it was like 6 months later, we got a valuation at $780. So it's like dramatic growth. But that also as well was standing in the way of another trend, which I noticed, which was people squeezing to affordability in terms of rents as well. So there was a huge amount of rental increase in cheaper rentals across Townsville because people had to get in cheap rentals. Cost of living was going up. So, we bought these things. I think they were all at $270, $260 a week each, and they're all at $350 a week each. So you bump the rents up. Obviously, the yield goes up and the inherent value goes up as well. So it was not just the demand on that side. It was also being able to stand in front of rental demand, increasing your rents as well. So it's sort of like a perfect storm. But I think it's a good example because a lot of people quite often can sort of talk about these things, but it's a good example to always show sort of what we've done and what we would think about or how we would think about property as well.
Yeah, it's super interesting. And it's also like, to your point, so obviously there are a lot more participants in the buyer's advocacy space, which broadly speaking, I think is a good thing, by the way. Just for anyone listening to this, I broadly speaking, think it's a good thing. I have some reservations around the capabilities of the participants in the market, and that's where my primary concern for investors exists. Like there's a lot of people out there who don't know what they're doing, and that's a concern. That's a concern for me. But broadly speaking, I think the proliferation of an advocacy space is good when it's good. So that's the sort of cautionary piece in there. I think the macro, it's good. I think there needs to be a bit of tightening up around the quality of what's going on there.
Because it allows people to invest anywhere in Australia, whereas traditionally you think if you want to go to the extreme, it was once upon a time, it was we need to invest somewhere within 5 minutes drive of us and we go and look at property and that's where we invest, which obviously would have prohibited a lot of people from ever getting to their goals. Whereas now when you look at it, we get more and more able to spread out and invest wherever, it's going to dramatically increase people's results and the amount of people that can get to their goals, I feel.
A second order effect that I think is good about it though, is that it kind of, and it sort of touches on the point you made there as well. It takes some of the emotion out of it, right? Because if you are self-investing, I'm just going to go do my own thing, then you're necessarily going to be more emotionally involved. If you put if you treat your real estate portfolio like a business, right? And if you can put an intermediary between you and the asset selection, you're going to start to run your portfolio like a business. Anytime I've seen an investor adopt that mentality, I've seen them make tons more growth in their portfolio. They move faster, they act better. The ones who are still holding on to it like, I bought a house and this is like and they get really kind of, it's
like the Tinder point again. People will just get attached to the look of it. I got a great story about that too. We moved from Bathurst up to Cairns, so I'd never seen that unit block, which obviously was a phenomenal performance, but I drove Maddie, my partner, through Townsville and we're like, we'll drive past it. We drove through that street, Maddie was going, I don't know, there's like instantly, like, not within the property investment space, but instantly if you had have just taken her, gone to this property, it would have been, no, thank you. This is pretty airy sort of thing. But nonetheless, it was an excellent performing property, regardless of how it looks or how it feels or what the street's like or whether or not I like spending any time in Townsville is completely irrelevant.
Yeah, 100%. And look, we saw that early on. There was a client that we were working with very early on in the Dashdot's journey, like back in early 2019. And we found a property. They happened to live like an hour and a half from where the property was. And they said, this is awesome. They were so excited. They were just like, can't wait. And so they decided to go there on the weekend, go check it out. And then they were like,
never ends well.
It never ends well. And they were like, oh my God. They said, I can't believe that you've presented this property. There are people here that are on the dole. And and I was like, okay. And like, they subsequently decided not to invest. Well, actually, no, let me reframe that. They actually did decide to invest. They decided to self-invest. And they told us about the property they purchased, and we stayed in contact for a while. The property they purchased over the last, over the subsequent 3 years, right, grew by something like 10 to 14%, something like that, in that kind of a vicinity. The property that they said no to grew by something like 67%. Right. And it's just like, it's like, like if you could have just taken an emotional step back, it's crazy.
It's one of the worst things we see. And we actually did another, I don't have the study up actually, but we did a study where we grabbed every single suburb in Australia and we tested what the 75th percentile home within the median sales price band and what the 25th percentile home had done in terms of growth over the last 20 years ish. So essentially what you're doing is you're picking a pretty ordinary, shocking house with the Commodores out the front, and then you're picking something that's nice, a bit close to the beach, all within the same suburb. And over the last 3 years, especially, the 25th percentile home dramatically outperformed the other home. If you wash it out over 20, they all grow about the same because the suburb will move at the same sort of rate. But especially over the last 3 years, the 25th percentile outperformed significantly. Like we're talking 40. I remember one suburb in WA where the 25th, it was a pretty hairy suburb at the best of times, but the 25th percentile property, which is like 250 grand, asbestos, like everything you think of that's you don't like in property, it had grown 45% annually. And the 75th percentile in the same suburb in the same study had grown something like 19%. So a phenomenal outperformance.
But it makes perfect sense, right? Because if you have a location, right, and on one end of the spectrum you've got, let me rephrase it. If you've got a location, there is going to be a limit to, based on the relative local affordability, there's going to be a limit to how expensive properties can get. Okay, so the upward mobility of prices has a cap, but from the lowest price property in the suburb, there's loads of room, right? So in the first instance, there may be more desirability on one end of the spectrum. Let's say get the houses closer to the beach, for example. But then those houses close to the beach get so expensive, no one can buy them. And so then then the delta between the lowest priced location and the highest priced location is the highest. And so then you have a spring effect that pulls the other one up. Right?
And interest rates squash that cap too. So over the last few years, that cap that we were talking about at the top end can slowly be restricted as well by people's access to credit. So,
yeah. Speaking of interest rates, what are your thoughts on interest rates in 2024?
Well, it's an interesting one. So interest rates, like we're in a perfect storm at the moment, macro, which will cause some substantial growth in 2024. I think if they throw interest rates into that mix, which is likely from all reports that we've looked at, you could start to see movement in a lot of these places where we've said have sat stagnant because of relative affordability. A couple of notches down in interest rates and a big spike in consumer sentiment, you might start to see growth moving back into a lot of the areas that have sat for a little bit. So you're talking your more expensive capitals, not necessarily your super blue chip, but your more expensive capitals. However, that's always an if and a but. It's when they come down, how much do they come down? You know, how relatively affordable is the suburb? There's a whole lot of things to throw in there. However, I don't see interest rates being the sole push for this kind of boom or price growth next year. They're not the only thing that's required for it to go up. There's when you look at the affordability in a lot of these places we've been talking about, there is so much room in these markets, these smaller capitals and regionals and places that haven't necessarily 200%ed like Sydney has in the last 10 years. There's still so much room in terms of affordability in these areas that interest rates won't be the only thing that pushes them along. It'll definitely kick them in the rear end if they do. However, it's not going to be the sole reason why they keep going.
Yeah, it's super interesting, right? Because consumer confidence, it's been hovering around 80 points since I think like mid-2022, broadly speaking, right? Basically, when interest rates started going up, pretty much, the consumer confidence had been tapering off. Everyone was talking about interest rate rises, and then it dropped to about the same level as it was during COVID. And it's been hovering around that mark since then, which is really interesting because the long-term average for consumer confidence is about 100 points. I think the peak was been like 124 points or something like that, but the average is about 100. And so you've kind of got this like subdued consumer confidence, kind of trend, which once the consumer sentiment changes, because psychographics are, in my point of view, they're far more important than demographics or any other kind of things we look at. So once the consumer confidence changes and people start to resume, that's going to be the big driver. But I think right now we're in and I've said this before, and I'm going to keep saying it because I believe it is true, that we're on the precipice of possibly the largest property market boom in Australia's history. And I don't say that lightly, and I don't say that to try and drum up freaking demand. I'm actually I'm a bit concerned, and I mean, just on that front, Dashdot, we're capping our client intake. So I'm not incentivized by this. We already have too many people trying to work with us, and we're going to be capping the amount of clients we take on board in 2024. And just on that note, if you are thinking about working with Dashdot, I suggest you get involved sooner rather than later because we are going to be capping the amount of clients we take on board in 2024, despite the fact that I'm sitting here saying I think it's going to be the largest property boom potentially in Australia's history, or at least in our lifetime. And to your point, interest rates are just one part of that. There's so many forces pushing in this direction consumer confidence will change, interest rates will change, we've got immigration, we've got
building approvals, all sorts of things.
All these kind of things. And it's super interesting because the narrative around interest rates is starting to change as well. And I noticed in the US, which the US and Australian economy is radically different. And so I'm very cautious of saying, if it happens in the US, it'll happen in Australia. However, on a sort of fiscal policy, monetary policy, fiscal policy type basis, the RBA tends to do things that are relatively similar to the US federal. And there's a lot of talk in the US at the moment about slashing interest rates. They've gone potentially too far in interest rates. I was watching an interview with Bill Ackman, who's a very successful investor. He turned $27 million into $2.6 billion during the GFC.
Pretty good role.
Yeah, pretty good. Pretty good. He's adamant. He said he thinks it's going to be cut quick and fast. And if you look at core inflation rates, so back in December, don't quote me on this exactly, but I think it was December 2022, we were at about 6.9% core inflation rate, and it's been dropping every single month since then. We're down to about 5.2%. So inflation's on the right trend as well. And so we're sort of, given the fact that interest rates are only elevated to control inflation, I think that the significant probability is that interest rates will start to come down, which will increase access to credit, which also will increase consumer confidence because people feel more like that they've got their standard of living under control, which is then, that's just going to be fuel in this fire. Do you agree?
Yeah, and inflation's definitely coming down more than they report. Like if we're gonna throw some flames at some people as well. Like when you're looking at inflation, one of the highest ranked or heaviest weighted parts of CPI is housing. And when you up interest rates, a lot of costs of housing, rents, immigration, all these other things are shooting rents up. So that will artificially inflate that inflation number, which will make it seem like it's way, way out of control. So you keep bumping interest rates, and a lot of the housing costs continues to rise due to a lot of these factors. So a lot of the other stuff that's weighted under it is what's dragging it down. However, sometimes I don't know that the RBA really knows what the left hand's talking to the right sort of thing, because you can keep jacking these interest rates up, and all you're seeing, like we're seeing it across multiple areas, is rents and prices going through the roof, which is then causing further inflation. So I know that there's multiple forces that they have to look at, but it's definitely not it's not reported. It's not a great example of what's actually happening on the ground. The CPI index, I don't feel.
Yeah, and said it before as well, but like the interest rate's a pretty blunt instrument. Right?
No.
It's like
it's one size fits all. We'll just jack this up and see how we go.
Yeah, it's like trying to do brain surgery with a sledgehammer. Yeah. It's like, okay, well, fair enough.
The Coles and Woolies lawsuit thing's another good example. I don't know if anyone's heard about this. Like they're saying inflation's going through the roof in Australia. Coles and Woolies have just recorded record profits. So they've obviously juiced these prices up. Costs of the stuff that they're selling has gone back down, and they just haven't gone through with it. So, the RBA might be just trying to smash inflation with this blunt instrument by juicing up interest rates. Coles and Woolies aren't fussed at all about interest rates.
And the banks. Banks, record profits. Yeah.
It's a very, very blunt instrument as to try to control something as complex as inflation.
So how do you think the investors should be thinking about 2024 then? Right. So, I think it's reasonable to say that we believe that interest rates are going to come down in 2024, but I don't think people should be waiting for that to happen, because I actually think that the opportunity exists to try and get in at first.
Before the opportunity is definitely before that. And if we go back to some of the factors that I think will have a far greater effect, like migration and stuff like that, I know we touched on it earlier, but just looking back over to where that is going, you can see here. Obviously, we were speaking about 450,000 people entering the country and it increasing. You can start to break that down into different steps as to where those people are going. You can look at internal migration to the regions. You can look at what states people are going. As you can see here, you can see as a percentage basis, Victoria, Queensland, Western Australia actually takes the cake on a percentage basis for international immigration, which is very, very rare. It's always been, for context, Sydney, Melbourne, Brisbane, like you're going down the capitals in order. This is overseas migration, not net internal. So very, very interesting that a lot of those people, even from overseas, are going to these more affordable capitals. So I even had a quick look. REA even gives you a bit of an insight as to where those people. So where international inquiry is coming through their website. So people that aren't in Australia yet. And you can see in terms of buying properties, it's a little bit more as you'd expect, but you got Melbourne up the top, Gold Coast number 2, which is quite unexpected, Brisbane, Sydney, and they've also split Greater Region and CBD, which I don't know about that, but you can see Perth's up here as well. Then when you go over to rents, you can see international people inquiring for rents. Again, Melbourne, Sydney, a lot of your people coming over on temporary visas, temporary working visas are going to go into the major capitals. But then you got Gold Coast, Brisbane, Perth up here as well. But
that effect has been in place for a long time. And typically what the movement pattern is for international, because they go to Melbourne and Sydney because they're more known, they know what they are. And so Melbourne and Sydney act like a reservoir. People talked about the exodus of the cities during COVID, but
because they only rent in those major cities, because they're coming over on these visas where they're not permanent residents yet. So you get this spike in Sydney, Melbourne rentals, and then they wait 2 years, this is 2 years away from seeing the big buy push of these people, but they'll spend their 2 years Sydney, Melbourne. Then when they go to buy, they're going to shift to these other sort of capitals, which are more affordable, which is 2 years after they've had their temp visa and now they're a permanent resident.
Yeah, or depending where they find the job opportunities and the lifestyle opportunities, lifestyle and affordabilities, right?
Yeah.
And so,
which is shown in that other stuff.
Yeah, exactly. It doesn't necessarily mean they're all going to wait 2 years, but like the thing is, the exodus from the capital cities that everyone paid attention to during COVID, because for the first time, the capital cities, they were like, oh shit, we've got net negative population growth in the cities because the international inflow had stopped, but the outflow had continued. Right. And so the numbers weren't drastically different during COVID than they'd been all the time. There's always people moving out of the cities and finding opportunities elsewhere in the country.
And I've actually got the numbers here too. So the red lines that you see is the net interstate migration. So people already in Australia leaving. So you can see here the overseas migration into New South Wales, plenty of people coming in, but then there's always more people going out. Same with ACT, Tasmania, surprisingly. Where's Victoria? Yeah, that's slightly
about Tasmania, isn't it?
Yeah, I was quite interested about that as well. But as you can see here, big inflows into Sydney, Melbourne in terms of overseas, and then reasonable outflows of people that are already in those cities moving interstate from there. So you can see like Western Australia has got the trio this year. They've got the overseas immigration coming in, people moving interstate, and then the natural increase.
And Queensland
affect that massively. But yeah, and then Queensland obviously even more impressive
well as well. Yeah, that's super interesting. And South Australia is quite interesting because it's neutral interstate migration, which is fascinating as well.
Yeah, it is quite interesting. So,
okay, so in previous podcast episodes, we've talked about the opportunity to look at unit markets for some degree of affordability opportunity. What other kind of things? So we've got these kind of macro trends that are pushing towards, what we can broadly say look like boom conditions. And, my strong advocation to anyone listening to this is if you are able to get involved in the property market, probably try and do that sooner rather than later, because you're only going to be spending more and losing more in opportunity costs if you continue to wait, because the opportunity exists right now. But outside of that, how can people think on a more granular level around these opportunities? So we've identified already that there's, in some localized pockets, there's going to be a huge opportunity in unit markets if you know where to look and where that fits in your portfolio. We can see that there's these macro trends. What else can you see for 2024? How people can think about this?
I'd probably just say another macro trend just to throw in there is the state of the building market as well. So what we've got here is just total volume of building approvals, which as you can see, we're at like 2012 lows. And even if you get to the granularity of that, I know we'll just speak about units, but year on year, multi-dwelling approvals, so that's any more than 2 tenancies on one. So you're talking unit blocks, anything where you're housing a number of people, is down 44% year on year, and single dwellings down 26%. So what that causes is a massive lack of places for these people that are migrating to Sydney, Melbourne, lots of these capitals, and need to rent. They're not permanent visas yet. There's a huge issue with the supply of housing for these people because there's physically no extra ones being built.
Yeah, that's hectic, isn't it? That's crazy when you see it on a graph like that.
Yeah, and even if you start cruising around, it's not just one. Like if I just start jumping around a few of the capitals and a few of the regions, it's not just one place. The rental, you hear a lot of people going, I need to invest here because of low vacancy rates. Oh, sorry, I've got the wrong screen sharing.
I noticed taking Tim's naming protocol.
Untitled presentation. Yeah, I'm good at picking property markets, not slideshows. So I do apologise. I'm doing my best here. But yeah, back to rents. If I just jump and I just do vacancy rates, because what I was saying is a lot of people claim that places are good investments because of low vacancy rates. You can see the trends all across Australia here. You're looking at critical levels of vacancies. So we're in Adelaide, bottom of Adelaide at the moment, 0.2. If we go back over to our Western Australia or anywhere even, let's just go in Rockingham, I bet it's going to be 0.5. You can even reckon up here in Cairns. I think I would do well right now. Oh, that's not right, Mount Sheridan, but I would do well to find a market over 1.5% vacancy rate. So the problem is definitely here, and there's no like, it's an existing problem that there's no sort of help on the horizon.
Well, see, once upon a time though, when the housing crisis wasn't as bad, using vacancy rates as a heuristic for market health for investors was useful, because once upon a time, not that long ago, back when we started Dashdot, there were some markets that was like 3%.
They would have been up
4%
here.
vacant. Yeah, exactly. Yeah, exactly. And so, we like, if it was below 3% vacancy rate, we were like, okay, that's a good signal. Yeah, that's good. If it was below 1%, we were like, holy smokes, this is insane. But now, basically everywhere is less than 1%. So, okay, well, that's no longer a useful reference point.
Because we actually proved out this concept. We measure vacancies a little bit differently, which is this green line over the top here. This is CoreLogic. More accurately. But that's this green line over the top. We actually proved with data science this neutral band, which I know I've spoken about in a previous podcast, but we actually proved back in the stages where we were trying to find places with rental growth and there was a lot of variance in vacancies, that once our measurement of rental vacancies was below this grey band here, it was extremely, extremely likely that rents would rise. So as you can see with these numbers that are all the way down here, we're well beyond the point where there's stress on the rental market.
Yeah.
And even if I throw a curveball, I bet if I go super regional, they'll be the same. Let's go about as regional as I can go. Broken Hill.
Humpty Doo.
I don't know. Humpty Doo even got any houses in it, or just a pub?
Yeah.
So a little Broken Hill.
Largest buffalo hills in the Southern Hemisphere.
Broken Hill is 1.4%. So I'm not, no harm to Broken Hill, but this is sort of what I mean. It's not a singular problem. It's a huge macro issue where there's pressure on the rental market wherever you're looking to invest.
Yeah. So what advice would you give to property investors that are thinking about investing in 2020? Because we're right at this time of year, people are thinking, the New Year's resolutions type thing. And they're like, right, what are the big goals that I'm going to set myself in 2024? What does success look like for me? How am I going to create the life that I want? What advice would you have to property investors that are thinking about investing in 2024?
I would say, and this is not just because we're in the industry, but I would say 2024 is going to be the year that will really sort the wheat from the chaff in terms of location selection. There's going to be locations that perform insanely, like hit record sort of boom numbers, and there's going to be locations that perform suboptimally. I think if you invest in a huge array of places, there's going to be some that will perform with any number of variants, but I would definitely say it's going to be a year where location selection is critical, and as well as that, getting in relatively quickly in a lot of these locations is going to be important, but challenging as well, because a lot of them are already in a state of pretty severe stress.
Yeah, it's really interesting as well, right? Like just to give that context, because of the 17-year stock lows, you could find the right place, but there just might not be properties to buy. Right?
You cannot buy on market in some of these places, and some of the places I was flicking up before in Western Australia. It's very interesting the way we measure supply and demand. You can see the gross supply of new listings dropping off dramatically. But in terms of demand, when we see that continuing to increase, that means there's still a reasonable amount of transactions going on, which means that virtually no one is buying on-market properties. What's happening? They're not even getting listed, so they're not getting registered as supply. The only transactions that are happening, and definitely the only transactions that are happening at a reasonable price, are all being done off-market. So it's very, very challenging to break into some of these markets.
Yeah, so I would actually just point that out, that's an interesting thing that investors should be thinking about. If you're working, because not everyone's going to work with Dashdot, and that's okay, that's all good. But for those of you who are out there, maybe potentially working with someone else or thinking about working with somebody else, probably a red flag you should look for is if they help you find a property like really, really quickly.
And it's on market, and in a market that is red hot.
Well, even just hang on a second. It doesn't need to be just like forget about if you know it's red hot. If they present you a property that's on market and they do that fairly quickly, that should be an indication that either the property sucks or the location sucks, right?
Or the price you're getting it for sucks is another.
Yeah, or the
one
price you're getting it for sucks. Like, it's a red flag, right? So one of the unfortunate and challenging things for us at the moment is because of our unwaveringly high standards. It takes time, like it's taking time, because with less properties on market, finding the gold just takes longer, which is challenging, but it's necessary. And I think that there's a real risk that people are going to get impatient in this kind of market as well. Just go, you know what? I'm just going to let me buy something. Let's buy something. And it's like, well, you could be like the example I gave earlier, the people who bought something who got, whatever, 10 to 14% growth over 3 years, or you could just chill for a second and find the right property and get 60-odd% growth over 3 years.
Yeah, because it's actually in our duty of care. Like, it's within our best interest to just give you well, not within our best interest, but in terms of speed, you could just give somebody a property and get them out of the system. But actually, it's within our duty of care to make sure that if it is going to take longer, it's better you find the right asset and take a little bit longer than just, get flicked through the system and buy something suboptimal at a suboptimal price. Yeah.
So that's just something to be careful of in 2024 if you're thinking about buying a property, that it is a tough market. It's probably the toughest market that I've seen. I think it's
the whole time I've been at Dashdot, I initially was within the analyst team, which looks at all the properties. The whole time I kept saying, next year, we'll be able to buy properties. It'll be a lot easier. Agents will start calling us for properties. Don't worry, next year. It's been a few years now. It's getting worse, not better. So it's definitely a challenging market. And despite what you see in the media, it's more challenging than it was in peak COVID times in a lot of these areas, not less.
Love it. That's awesome. Sean, anything else you want to cover off before we wrap this episode up?
No, all good.
I think we've covered a lot of ground here. I hope it's been useful. And if you're listening to this and if you want to find property investing success in 2024, as I've mentioned, Dashdot is going to be capping the amount of clients that we take on board. And we're doing that because we need to be able to maintain the quality of service, quality of experience, and quality of results that we get for our clients. And we take absolute pride in making sure that we do that. So there are going to be very limited spaces for people to be able to work with this in 2024. So if you want to try to participate, if you want to see if that's a good fit and see if we can help you too, and if we've got enough space, then I encourage you to book a call, dashdot.com.au/discovery. Put a link in the show notes. This is the start of something big. I don't want you to miss out. Make sure you're taking care as you progress on your wealth journey so you can create the life that you always wanted and, quite frankly, the life that you deserve. Sean, thanks so much for your time. And if you've liked this and you're listening to this and you like it, make sure you like, rate, review, share with a family, friend, or loved one. Till next time. We'll see you soon.